Well, hello, everyone, and welcome to the Benjamin Z. Miller Investor Networking Group. It is nice to have everyone here, and we've got a really interesting topic today that every investor should know about. And in this presentation, I'm going to show a few things that even if you're an experienced investor, you may not be doing on all of your deals that would be worth considering. So the first thing is we'll just go through a few of the important things with insurance. If we talk about multifamily insurance or just insurance in general, but multifamily in particular, it has a history in the United States that dates back to basically the early 20th century. And over time, this multifamily insurance has actually changed a bit in terms of how it is more specialized, but a lot of what we'll talk about today, it applies equally well for either multifamily or other categories of insurance. But some of the examples today are going to be more of multifamily. So property insurance, that's what covers the actual asset. Liability insurance, this is what actually covers from lawsuits against tenants. Then there's another category of insurance that's called loss of rent coverage. And this is actually where you can get payments if something happens like a fire or some other natural disaster. The deductible is a term that everybody needs to be familiar with, and it's just the specific amount of money that you have to, before you can get a payout from the insurance company, you have to first cover the deductible on a claim. So, and then we're going to talk about some examples of replacement cost value and actual cash value, and I'm going to show two different examples that show how sometimes the replacement cost is favorable and other times the actual cash value. So let's talk about business interruption insurance, which is an additional coverage option. So imagine that you have a multifamily property and there is a fire that takes out, say, two or three or four of your units. Let's imagine that none of your tenants were hurt. They all got out safely. But now, as a result, the tenants are saying, the units are burned. I'm not gonna pay rent. I can't pay rent on something I can't live in. But you're the person that you owe a mortgage to, or the bank. They may or may not be understanding about that. But at any rate, if you have a type of insurance that's called business interruption insurance, and there are extensive repairs that are required, you can get a payout on these affected units. So it's something that is not included in every policy, but it's something for you to consider because it could happen. Then I want to also mention what's called an umbrella additional coverage option. So let's imagine that you have a tenant, and the tenant one day, there's some snow and ice on the ground, and he's going to work and he slips and he falls. And let's say that the tenant's brother is a lawyer, or maybe his cousin is a lawyer, and they decide that the only thing that makes sense to them is to sue because that landlord's really rich, and he should have had someone out there shoveling the snow. So he's entitled to sue, he thinks, and he goes forth with this. Now, if that happens and there's a serious injury and the tenant successfully conducts a lawsuit against you, and imagine that the tenant wins, where he actually wins a big lawsuit. Your primary liability insurance may not actually cover an outrageous lawsuit that has a really high payout, but if you have an umbrella coverage option, you can have it cover more than the minimum. So that is something to also think about. Now let's take some examples of replacement cost versus actual cost value. And when I first started investing, I had this explained a lot of different ways to me, but these examples will make it more clear. So let's imagine that you have a multifamily property and there is a hailstorm. And when you purchased the property, you decided to get replacement cost value instead of the actual cash value. So on the replacement cost value policy, they are going to look at the roof and they're going to say, well, you know, the roof, to replace it, it's going to cost $50,000. So we're going to, subject to your deductible, we're going to pay out $50,000. And in that particular example, you would get 100%. But what if you had instead purchased an actual cash value policy? In that instance, the calculation works out differently, because the insurance company might say, well, you know, we think that the roof has a lifespan of 20 years, yet it was already a 10-year roof when you purchased this and when you got the actual cash value. So we would consider that that roof has depreciated 50% in value. So if the total replacement cost is $50,000, because there's 50% depreciation, we're only going to pay out $25,000. So that would be an example there. Now let's imagine a different example. Let's say that there's hardwood floors, and these hardwood floors were installed 15 years ago, and there's some sort of water damage due to a burst pipe. With the replacement cost calculation, let's imagine that to replace the floor is going to cost $10,000, and the insurance company is going to consider that the life of the floor is 20 years. So they would apply a depreciation rate of 75% because it's 15 years on a 20-year. So as a result, the company's only going to pay out $2,500, which is pretty frustrating if it's going to cost $10,000 to have it replaced. Now imagine that instead, the actual cash value policy was purchased, and the flooring, let's imagine that the flooring is 15 years old and it has reached its expected lifespan. So the insurance company may actually reimburse the current value of the flooring. So if the current value of the flooring is, let's say, $3,000, the insurance company would do a reimbursement of $3,000 instead of only $2,500. So it can vary a bit, which works out more in your favor. It just depends on different factors. Another example of an exclusion is earthquake or flood. These are very common exclusions. And if you happen to have had the bad luck of purchasing an insurance policy and you got one without flood, and then you get a flood, you can have a disaster where your tenants are at your multifamily property and look, everything is flooded and you didn't get the right sort of insurance. You just figured, well, you know, I never thought there'd be a flood. And then, wow, a flood happens. Lightning has struck. So at any rate, this can be an example of an exclusion that it would have been better if you had purchased flood. Another common exclusion is wear and tear or a maintenance exclusion. So the insurance company says, you know, this is just normal wear and tear, and we're not going to let you file a claim. We're going to reject your claim because this is not a valid claim. This is normal wear and tear. So this is something that can also get your claim kicked out. And then a great one is intentional acts. And here is a wonderful example of an intentional act. This is a real thing that happened in a Tampa commercial building. There was a foreclosure sale, and somebody, it could have been the owner of the building, it could have been somebody else, we don't really know who it is, but they were angry and they wanted to make sure that when that asset changed hands, that it was an expensive operation to fix, and they actually put cement in all of these toilets, which is extremely difficult to fix, extremely costly, and it's also considered by insurance company an intentional act. So when you try to file a claim on that, the insurance company will be likely to reject it, saying, oh, no, that's not a valid claim. That's an intentional act, and your policy did not cover intentional acts. So you can just pay for it yourself. We won't be putting any money in. And that's the type of thing where when you're buying these policies, it can seem so boring to read all of these little details. But when a problem happens, it's very unfortunate if you don't know what you are purchasing and what it means. So what do you do if you have a situation where you try to file a claim and then the insurance company, they reject you? They say, no, there's nothing wrong with the roof. We're not going to do that. We're not going to pay. That's normal wear and tear. They reject your claim. Unfortunately, what a lot of investors do is they just don't know that they have a lot of options. They have options that won't even cost them any money. If they're not happy with what their insurance company is saying, and if they don't agree with it, they don't have to accept that. Instead, for no money, they can just go and get an adjuster. It doesn't cost them anything. The adjusters, they all do it on a contingency basis where you work out a deal with them and they'll say, look, whatever I can get you, you pay me a third, or you pay me 25%, or whatever it is on the increase. It's usually on the increase, but the beauty of that is you are saving your time. And now you've got somebody that has a lot of experience working on your behalf, talking to the insurance company, letting them know that you don't accept that you want more money. And this actually can generate a far higher payout. And it's something that is so easy to do, yet so many investors are unaware of it and may have never done it. But it's amazing the results that an insurance adjuster can get. And you don't even have to talk to the insurance company. You just call up the adjuster and, get them started on it, fill some paperwork out. They'll go take pictures. They'll go do all of their magic. So nice. Now, here's something that is the most useful thing when you are buying assets. And it's something that I would say 99% of investors overlook. They forget about, they're unaware of, but it is a huge opportunity that's relatively easy to implement at a closing table. So let's imagine that you have worked out a deal to purchase an asset from a seller. You're going to buy, for example, a multifamily property, or you're going to buy a rental property, whatever it might be. Well, you will tell that seller that you're going to buy the property and you're going to prepare the paperwork. Your lawyer is going to put the paperwork together, and then you'll just mention that have you ever filed an insurance claim? You'll make a note on that. You'll get information. But then you're going to gather the information on their current insurance, and you are going to have your lawyer put together a document that's called an assignment of insurance proceeds, and also a limited power of attorney for insurance. And what this lets you do is, after the sale closes, let's say that you buy the property in January, and the seller had insurance for last year, and there was a hailstorm, and you were busy, you haven't inspected everything, but you told the seller you'd buy the property. And it turns out that when you have your roofing company do an inspection, or where you have your expert people do an inspection, they discover that there is a valid claim that was never filed. Well, because of the fact that you had the seller sign the insurance proceeds and gave you a limited power of attorney to file a claim on his policy, you can now, with your lawyer, it's best to do this with your lawyer, you can now actually file a claim. And potentially, if there was an undiscovered claim that you discover after you purchase the property, great. And let's say that you purchase the property and there are no valid claims. Well, obviously, you're not going to file anything if there's nothing there, but if you have a legitimate claim, you can do this. And a lot of times people aren't aware that there could be legitimate claims. So that's why it's important to, in the paperwork when you purchase assets, to have that part of the document. So the seller's ready to get their money. They're not going to object to assigning insurance proceeds to you on some claim that they don't even think exists, may not be aware exists. They just are going to sign the documents, and you may never use these documents. On the other hand, you might need the documents, but at least you will have the option, if you discover that there was an unfiled claim that needed to be filed, at least you can do that. So it's an option to you. So that is it for the presentation. Just a couple of things to mention. We have these meetings every single Sunday. You are invited. Your friends are invited. If you know other investors, they are also invited. Come one, come all. We welcome everyone to the Benjamin Z. Miller Investor Networking Group. And I also am available. If you're seeing this on the internet, maybe you're watching these videos on the internet and you're thinking, yeah, that's great. I'd like to learn more about investing, but I don't know what to do. I wish I had a mentor. Well, you are in luck. I am available for mentoring. And if somebody out there on the internet happens to see this and thinks, I could do so much better if I had an experienced investor like Benjamin Z. Miller helping me, just reach out, just give me a call, send me a text message, email me. I hope that helps. And I wish you good luck with your investing.